Hey, well, it is 12:01, so we try and be timely around these parts here at CMP. But welcome everyone that has joined. This is the CMP presentation of some changes to the tax law coming for 2025. The passage of the big beautiful bill has changed a lot for us, and this is the big beautiful webinar to hopefully explain those changes and make sure all of our clients and all of our friends are up to date on those changes. So we're going to go ahead and get started. This next slide, we're going to explain a little bit how the webinar works. You can't chime in just because of the volume of the participants. So you're going to have to use the chat to communicate with our staff. I've got 3 excellent accountants working with me today. Zach, Brooke, and Dylan will be working to respond to your questions and answer any things that you may wonder about. So we're going to work on responding to you as fast as we can, but with volume, sometimes it might take just a minute. If we are unable to answer your question, maybe it's a specific situation that applies to you, we'll refer you to your CPA and make sure you set up an appointment with them so that you can get that question answered. Today, though, mostly is a general information. We're trying not to delve too much into specifics. If we have, sufficient interest, maybe we'll do a second one. But for today, general information. But if you have questions, drop those in the meeting chat, and we'll respond to those just as soon as we can. One disclaimer that our partner group has requested we send out there is we are not politicians. We do not support one point of view or another. We're just here telling you the tax consequences of the law that has passed. We're really just here to discuss the tax changes. There may be pros or cons of the bill in its entirety. We're here to just discuss the tax changes. So we'll go ahead and jump into the information of this webinar. First and foremost, we're going to talk about changes to individual taxes. Later, in a few minutes, we'll jump over to business taxes. So if you have questions about business tax, hold on to those for just a few minutes. We'll get to that just as soon as we can. Kind of an overview of our individual tax section that we're going to go over are the following changes made in the big beautiful bill. No tax on tips, no tax on overtime, no tax on car loan interest, new deduction for seniors, permanently extended certain Tax Cuts and Jobs Act adjustments. So that was the last tax bill passed by the Trump administration in 2017, certain other adjustments for individuals, and then the elimination of certain energy credits and deductions. So that's kind of the summary of our individual tax conversation today. So very first and foremost, the no tax on tips. This was a promised campaign change that President Trump made, and this is how it was delivered. The no tax on tips is for employees and self-employed individuals, and they may deduct up to $25,000 per year in qualified tips. So what are qualified tips, you may say? They're voluntary cash or charged tips received from customers or through tip sharing. So that is the definition according to the IRS. There's going to be more information about what qualifies as a tip and what doesn't, but talk about some limitations. This no tax is effective for tax years 2025 through 2028. This is an above the line deduction, and the deduction phases out for individuals above 150,000 of income or 300,000 for married families. So as a part of this, employers or other payers must file information returns with the IRS and furnish statements to taxpayers of the tips received and the occupation of the recipient. So that's an important, component there, is that the IRS has published a certain list of occupations that qualify. And I can actually go ahead and pull that list up for us to look at, but it's just a, general list of occupations in regards to the no tax on tips. Let's see if I can get out of our slideshow here. Let's pull this up. Occupation list. So these are occupations that customarily and regularly receive tips. We can drop this link in the chat below, but basically this is, according to the IRS, occupations that qualify for this. So whether they're employees or self-employed individuals. These are kind of the occupations. So, one that I personally found funny is we'll scroll down here was let's see, golf caddies. For those of you that like to go golf at expensive golf courses, maybe they have expensive caddies that are required. Any tip is not going to be taxable to those golf caddies if it's less than 25,000 per year. So, look through this thing. Maybe this applies to you, maybe it doesn't, but that's kind of the new rule for no tax on tips. We'll go ahead and jump back to our slides. That's the list of occupations that generally receive tips and are eligible for this deduction. So unfortunately for us as CPAs, we can't modify our agreements to, our fees are nothing. We're only now charging tips and they're mandatory, and then avoid tax on the tips. That's just not how that works. They're generally for those list of occupations only. So that's how no tax on tips is going to work under the big beautiful bill. Moving on to no tax on overtime. Again, this is effective 2025 through 2028. Individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate of pay, which is the half portion of time and a half compensation. So let's jump into the half portion of time and a half. Some understood from the bill that the entire amount of overtime that you received is non-taxable. That is not correct. Only the half portion, or the additional pay that you receive for overtime work, is going to be non-taxable up to the limits posted here. So $12,500 for a single individual and $25,000 for a married. So let me give you an example. We're looking at, let's say that I make $20 per hour when I work, my regular pay. Overtime, time and a half, would be $30 per hour. So if I was earning overtime compensation, only the $10 difference between 20 and 30 is non-taxable. The regular $20 per hour is taxed just like normal. So this deduction is not quite as big as some maybe thought it was going to be, and that's because of that, the half portion is the deduction there. Similar phase outs to the no tax on tips, phases out at $150,000 for single individuals or $300,000 for married. So a couple of notes that those of our clients or people that are watching who are business owners and have employees should be aware of is that W-2s will not be updated for 2025. There's not going to be a note on the W-2 by default showing the amount of overtime. Your payroll processor is probably not going to automatically do this. The IRS will publish additional information soon, but in talking with a couple of our CPAs around the office, most likely employees are going to be coming to you asking what to do. And the answer is, employees will need to use pay stubs to determine the tax deduction. Most payroll softwares have to break out the overtime component. That overtime component is normally just stated in dollars. So how do we, get our tax deduction from that? Because it's just the half portion. The simplest method we've found to do this, and hopefully we get additional IRS guidance soon, is simply 1/3 of your total overtime pay will be the tax deduction amount. So if you received $5,000 in overtime pay in 2025, multiply that by 1/3, and that is your tax deduction. So hopefully we'll gather some additional information from the IRS in the coming months. And as W-2s are processed, that's something we're going to be heavily involved with for our clients, is ensuring that whatever information we can put on there, we do, just to avoid, multiple questions from employees. They're filing taxes, they don't know what to put. So the no tax on overtime is just the half portion. For 2025, W-2s will not be updated, and the limit is $12,500 for a single person and $25,000 for a married couple. So those are the limits. That's how that deduction works. 1/3 of your overtime pay will be your tax deduction amount. The next one is, an interesting carve out. No tax on car loan interest. So for the same years as the previous deductions, 2025 through 2028, Individuals may deduct interest paid on a loan used to purchase a qualified vehicle, provided the vehicle is purchased for personal use, so not business use, and meets other eligibility criteria. Specifically, lease payments do not qualify. So, this could be one tax advantage of purchasing versus leasing. Anyone that goes to buy a car, I'm sure the salesman will be right on top of that. So a couple of limitations. The maximum annual deduction for the car loan interest is $10,000. That's a lot of cars, so hopefully, that's a lot of interest as well. Hopefully our clients aren't hitting that. The deduction phases out for taxpayers with income over $100,000 if they're single, or $200,000 if married. Specifically, to be qualified interest, in order to qualify for the deduction, the interest must be paid on a loan that is originated after December 31st, 2024. So that means it has to be a new car in 2025, used to purchase a vehicle originally used by the taxpayer, meaning used vehicles don't qualify. It is new only. It's a personal use vehicle, as I mentioned above. And then, of course, the loan is secured by a lien on the vehicle. Couple final notes. The gross vehicle weight of the vehicle needs to be less than 14,000 pounds. So big rigs, if you're driving those around for personal use, sorry, no interest deduction there. I don't think that's very common. And then additionally, final assembly must be in the US. Most cars are assembled here, even those that are, foreign produced, but, it's something to look at when you go and buy a new car. Where was the final assembly and is it new to you? So an interesting new deduction. This is an above the line deduction, so you don't need to itemize to take advantage of this deduction. So could be something that many of our clients will take advantage of. And the reason why, if it's business, it doesn't qualify is because if it's a business vehicle, you should already be deducting the interest on your business taxes. So no change there. Alrighty. One that I know many clients are excited about and that I've already, fielded some questions for is that a new deduction for seniors. So again, the new same time period, it's temporary, 2025 through 2028. Individuals who are 65 and older may claim an additional deduction of $6,000. What's cool about this is this new deduction is in addition to the current additional standard deduction for seniors. So there was an existing standard deduction for seniors that was small, and now they're getting an additional $6,000 per person. So I kind of walked through an example to show what a standard deduction will look like for a married couple of seniors in 2025. So in 2025, and we'll get to exactly what those look like, but the regular standard deduction for a married couple in 2025 is $31,500. Current senior deduction is $3,200. We will tack on top of that the new senior deduction of $12,000. That's $6,000 per spouse. So for a senior couple who are both age 65 or older, their standard deduction will be $46,700, which is sizable. Some of the news places have touted this as, they're removing tax on Social Security or something like that. It's not quite that simple. This is simply in addition to your standard deduction. Depending on that, will then determine how much tax you pay on your Social Security or pension or retirement income. So it's not exactly a wipeout of tax on Social Security. It's just an additional standard deduction that will reduce your overall tax. And it can help, you avoid tax on Social Security, but that's situation by situation and something we'd love to chat about as we do tax planning. Something important to note on this is for lower income taxpayers. The deduction phases out for single taxpayers with income over $75,000 or married taxpayers with income over $150,000. So relatively low income limits when it comes to in general for our clients. Important to note that for someone that's retired, receiving Social Security and a pension, this is generally an excellent deduction for you. So this is the new deduction for seniors, sometimes touted as the elimination of tax on Social Security. In reality, it's just an additional standard deduction. Jumping over to some miscellaneous adjustments for individuals in the big beautiful bill. The child tax credit is being increased from $2,000 to $2,200 per child. 1,700 of that credit is now refundable, and the credit is now subject to annual inflation adjustments. Before, it was just kind of set in stone, and sometimes Congress would change it temporarily. Now, it is permanently up to 2,200 and will be adjusted for inflation. There have been some modifications to Social Security number requirements. So if that's something you have concerns about, that would be a question we could talk about. The $500 other dependent credit. So that's for kids over the age of 17 or other dependents like a parent who's living in your home that you provide for. That credit was temporary on the previous Trump tax bill. That credit is now made permanent. So it's not going away. One thing that's really important for high net worth individuals is the estate and gift tax exemption has been permanently increased. So the Tax Cuts and Jobs Act doubled the lifetime estate exemption, and that was set to go back to the way it was, or get cut in half in 2026. The big beautiful bill permanently increased that exemption. So in 2026, you can pass $15 million to your heirs tax-free. That also, includes gifting. So if you have questions about the estate and gift tax exemption, that's definitely something we would advise you to, sit down for a meeting with a CPA to discuss kind of your situation. We'd love to chat about that. And this final point is an interesting one, but there's a new tax deferred account or a Trump account has been created, and a federal $1,000 contribution for qualifying children born in 2025 through 2028 will be made. Unfortunately, my daughter was born December 30th, 2024. So she didn't get the $1,000 just by nature of a 2-day swing. So unfortunately for her, she doesn't get a Trump account, but we can still go set one up for her. Those accounts, can grow in tax deferred as they, can accumulate, and parents can make contributions to that. It's probably not the greatest investment account out there, but it's something you could look at, and especially with a free $1,000, could be worth looking into. If you have questions about those Trump accounts, feel free to reach out to somebody at CMP. We'd love to chat about that. Alrighty, so for 2025 and going forward, there have been some changes to itemized deductions. Many of you know that there is a cap on the amount of state and local taxes that you can deduct on your taxes. For the last several years, that cap has been $10,000. For 2025 through 2029, the cap has been increased all the way up to $40,000. There is an asterisk on that as your income goes up, the deduction phases out. So for taxpayers whose income goes north of $500,000, the phase out brings it right back down within a little bit to $10,000. So for taxpayers under that $500,000 of income, the deduction is $40,000, and as your income grows, the deduction decreases. The deduction will revert to $10,000 in 2030. So this is a temporary change as well, but it's a nice one for people that pay a lot of property taxes. I work with clients in Texas and in New Jersey, and I've seen some pretty crazy property tax amounts, upwards of 10 or 15,000. So they wouldn't even get to deduct their income taxes because the property tax was so high. So this is a great opportunity for our clients to be able to deduct all of the state taxes that they pay. And it'll be interesting to see how that changes going forward. The SALT, or state and local tax thing, is a frequent tax planning item for us. So if you have questions on that relating to your specific situation, you should schedule an appointment with your CPA for tax planning later this year. One exciting new deduction for non-itemizers, or people who don't have enough deductions to itemize, is there will now be an above the line deduction for charitable donations beginning in 2026. So beginning in 2026, a single taxpayer could deduct up to $1,000 of charitable donations without itemizing. A married couple could deduct up to $2,000. So this is a great opportunity, for people that, can't gain any tax benefit from their donations because they don't make enough per year. to finally get a tax benefit. We love that, and we love the ability to deduct those donations. A change in the Tax Cuts and Jobs Act was that the mortgage interest deduction was decreased to $750,000 of loan principal. The Big Beautiful Bill made that adjustment permanent. So that is now the limit for the deductibility of mortgage interest. And something that is great for young people is that now mortgage insurance premiums, or for people that are required to pay PMI, those premiums are now tax deductible like mortgage interest. They were deductible for a few years, and then it was taken away, and now they are deductible again. So for people that have less than 20% equity in their home, they're generally required to make those mortgage insurance payments. Those will be deductible. So this is some wonderful changes in our opinion for taxpayers, whether they itemize or not. Could be some great options for people here. Finally, this was something that was decried across the news media, but there have been changes to energy credits. So we're talking solar credits, we're talking EV credits. So the energy efficient home improvement credit, that is done after December 31st, 2025. Same with the residential clean energy credit. This one is known as the solar credit. So the credit will not be allowed for any expenditures made after December 31st, 2025. Expenditures made is a little bit vague. With a client that's installed solar, I did some research and we discovered that expenditures made actually means the work has to be completed. So the work needs to be completed before December 31st, 2025 for the taxpayer to claim an energy credit. So 2025 will be the last year you can claim those. Beginning in 2026, there will be no solar credit. For vehicles, it's actually even more restrictive. You have 20 days to purchase an electric vehicle, used or new, and qualify for a credit. So that's this 25E credit right here. That's for used, and the 30D. So no credit allowed after September 30th of this year. So this month is the last month to purchase an EV. The rest of these credits up here are relatively uncommon. Take a look at them. If you have any questions, that's a conversation with the CPA. Unfortunately, these credits are being removed in the Big Beautiful Bill. So that is the end of our individual tax discussion. Hopefully we're able to answer some of your questions about the coming changes. No tax on tips, no tax on overtime. If you have additional questions, please drop those in the chat and set up an appointment with your CPA if need be. Jumping into the changes in business taxes. It's kind of a summary of the changes made in the Big Beautiful Bill. We've got permanent restoration of bonus depreciation. So that's a huge one that we love and many of our clients love. Doubled the allowable Section 179 depreciation. We'll talk about that. A big change for our clients that operate in the software development or new product development is the IRS has brought back immediate expensing of previously amortized research and development expenses. So that's a big one. We'll talk about that a little bit. But if you have questions about R&D, that's definitely a complex area and something you should seek out some professional advice. Finally, permanent extension of the 20% 199A or QBI deduction. This was probably the most popular tax law change in the Tax Cuts and Jobs Act that was passed in 2017 by the first Trump administration. And so they made good on their promise to extend that business deduction, so qualified business income deduction. And we'll talk about kind of what that is. And then some good housekeeping items, increased reporting threshold for 1099 filings, and an enhanced 1202 small business stock gain exclusion. So that one's not applicable to everybody, but it's important and worth talking about. So we'll jump right in. So bonus depreciation, what is it? Bonus depreciation is a form of accelerated depreciation, and it allows business owners to deduct a percentage of an asset's cost in the year of purchase. Ordinarily, without bonus depreciation, assets all have a set life. 3, 5, 7, 15 years is how long you can take those depreciation expenses. So for an asset that's $50,000, like this tractor, under some previous regimes, you would have to deduct that over 5 years. With bonus depreciation, as long as the asset qualifies, you can deduct the entire cost of the asset this year, so the year of purchase. With the bonus depreciation, it is now permanent. It's not going anywhere. So, unless there was a law passed, but it is an awesome deduction for our clients that invest in machinery, for our clients that invest in work vehicles. As long as those vehicles qualify, then you can take in, the entire cost up front. It applies to most assets other than real estate, including vehicles, computers, software, furniture, appliances, and equipment. So this is a huge, huge benefit for our clients. It's one we see really commonly, one of our favorite tax planning strategies as well. So if you have questions about whether an asset you've purchased qualifies, absolutely, please, talk to us and ask us questions. And then, we'll look forward to many years of bonus depreciation going forward. There's a special carve out for manufacturing. So I said on my previous slide that real estate is not eligible for bonus depreciation, and that is generally true. But the One Big Beautiful Bill Act creates a new elective bonus depreciation for the portion of the real estate manufacturing facility that is dedicated specifically to manufacturing. So it has to be performing manufacturing activities. Those are defined as manufacturing of tangible property, agricultural production, chemical production, or refining. So this is a nuanced and a complex area, and it is new. So if you have questions on if your manufacturing facility qualifies, definitely come seek us out. It does need to be constructed starting in 2025. So an existing facility wouldn't qualify for this bonus depreciation. But instead of deducting it over 39 years, you can deduct a portion of the total cost in the first year. So this is an excellent tax benefit to, benefit manufacturing. That was one of the goals of the Big Beautiful Bill, and this is kind of the mechanism for that. So that is manufacturing bonus depreciation. Section 179 is very similar to bonus. It allows an immediate deduction for purchased assets in the year of acquisition. There are dollar limits on Section 179. Historically, that's been a little over $1 million. It was doubled with the Big Beautiful Bill to $2.5 million for 2025. So that is the amount of assets that you can expense under 179. We really like 179 for our taxpayers that we work with in Idaho, because Idaho and some other states don't actually allow bonus depreciation. So by using Section 179, we're able to sync up the federal and the state taxes. So if you live in Idaho, this is a great opportunity for you. Can be some additional benefit for you. 179 is here to stay, and it has been doubled. All right. Moving on to R&D. So Section 174, research and development. So for businesses that develop new products, techniques, or software, they often incur R&D expenses. Those come in the form of wages for employees, payments to contractors, supplies used up in the tinkering and prototyping stages, maybe computer costs. All of these costs can be considered R&D in certain circumstances. Under previous law, any expenses that were considered R&D, they actually had to be capitalized, meaning you didn't get the deduction in the current year, and you would amortize them over 5 years. So you would spread the deduction out. So you can imagine for certain businesses, if they spent $1 million on R&D, all of a sudden that increases their income dramatically. This was a huge drawback from the previous tax bill. They allowed it, and then it phased out over time. So, this is one thing that we are glad to seek on, for our taxpayers and clients that we work with that work in R&D. This is an awesome change that we are glad to see. So the Big Beautiful Bill, how did it change it? It removed the need to capitalize the expenses. You can now just expense them as they are incurred. In addition, taxpayers can amend their previous year returns, 2020 through 2022 through 2024 to remove the capitalization and take the full deduction. Alternatively, you can take all of those deductions on the 2025 return. So it's a great opportunity, for tax planning and kind of look at, what does amending the returns look like? How does that benefit you? Or, what does catching it up on your 2025 return look like? So for many, clients working in R&D, their 2025 returns going to be their best tax return for a while. That's, a huge benefit that we love to see. So R&D, though, determining if you qualify is arguably the hardest part. So if you have questions on whether expenses you are incurring qualify, please seek one of us out. We can definitely help you to make that determination and see if you are eligible for the R&D tax credit, which is the whole reason you would claim these R&D expenses. So that's something you are interested in, please reach out to your CPA, or if you're not a client yet, reach out to one of us on this call. Continuing on, Form 1099. So 1099s have been in existence for a long time, and since 1954, the threshold to file a 1099 was $600. So if you made $600 in 1980, you got a 1099. And if you made $600 in 2024, you got a 1099. It seems silly that they had never indexed that for inflation. And so finally, with the big, beautiful bill, that has been changed. Now, if businesses pay individuals or contractors less than $2,000, they are not required to issue a 1099. Now, as your accountant, I have to tell you that you still have to report the income even if you aren't issued a 1099. But this can really alleviate, our business owner clients from issuing all sorts of 1099s for maybe small jobs or, infrequent employee contractors that are paid on a 1099. So great opportunity to save on some tax compliance costs. That threshold will now be I should mention, beginning in 2026, the threshold is $2,000. So in 2025, we are still stuck at the $600, but in 2026, that's going up to $2,000. So that's a welcome change, one that couldn't come soon enough. Similar but different 1099K. These are 1099s from third-party settlement companies, Venmo, Cash App, PayPal, basically online payment processors. They issue 1099Ks to users. So there's been rumblings for the past several years about whether the IRS was going to require more stringent 1099 filing requirements. And in fact, beginning with 2025, that was going to be $2,500. So if you had received more than $2,500 from Venmo, potentially you would have been issued a 1099. Fortunately, that threshold has been adjusted to $20,000. So you're not going to get a 1099 for selling stuff at a yard sale. It's going to have to be much more significant than that. So that threshold is now $20,000, something we are all grateful for. A lot less confusion and cause for alarm there. So those are the 1099 changes that are coming our way. We're excited to see those, and hopefully, that can alleviate some of the compliance burden on our clients. Now, finally, we're on to our last topic, which is 1202 stock gain exclusion. This is a narrow field of people that qualify for this, but it's worth talking about. For those taxpayers that are organized as a corporation, potentially investors or owners of their shares can avoid gain on the sale of those shares given certain circumstances. So in the big beautiful bill, the total gain exclusion allowed has been increased to 15 million, and the corporate asset limit has been increased to 75 million. So under previous regimes, if you purchased corporate stock in a small business corporation, and at that time, the corporate assets were less than 50 million, theoretically, when you sold those shares, as long as you had held them for 5 years, you could exclude up to 10 million of gain. Now that limit has been increased to 15 million, and the corporate asset limit for when those shares are issued has been increased to 75 million. In addition, there's now a tiered exclusion, so you don't have to hold the stock for 5 years to get all of the gain exclusion. If you hold it for 3 years or 4 years or 5 years, you can get a certain amount of gain excluded. So For those taxpayers that are organized as small business corporations, that are maybe bringing on investors, this is an incredible tax benefit. If you have questions about this, please, this is a complex tax topic, and we'd love to sit down and talk to you about it. That being the final item, we are now done with our Big Beautiful Bill webinar. If you have additional questions, we'd love to take them now. You can drop them in the chat. If there's a lot of questions about a similar topic, I will go ahead and respond to those. Otherwise, my wonderful partners will respond to your questions. We're so grateful for your attendance today, and we hope that we were able to answer your questions. And if you do need additional counsel or advice, we'd love to set up a meeting with you. Again, this was the CMP Big Beautiful Bill webinar. My name is Quinn Johnson. I'm a manager in our Logan office. And my thanks go to Zach and Brooke and Dylan, who have been diligently answering all your questions. And we look forward to continue to work with all of our clients, and maybe some of you on the call aren't clients, but if you have any questions or would like to work with us, we'd love to work with you. We will go ahead and end the webinar. Thank you all for your participation, and we look forward to continue working with you. Thanks.